5 weeks ago, this was, by every measure, the biggest initial public offering in the history of the stock market. $2 trillion in valuation in a single trading day. Today, the stock is trading below where it opened, and the people who own almost all of it still aren't allowed to sell. This is the story of exactly what actually happened in between. And who wrote the rules that made it possible. Friday, June 12, 2026. Times Square is lit up with rocket imagery. Down at the Nasdaq building, a crowd has gathered outside. The kind of crowd you usually see for a product launch, not a stock listing. Inside, Gwynne Shotwell, the company's president, an engineer who joined this business in 2003, back when it hadn't put a single rocket into orbit, rings the opening bell. Elon Musk appears from Texas, and with that bell, the most valuable private company on Earth stops being private. Shares are priced at $135. They open at $150. Within hours, they're past $160. By the end of the day, the company has raised roughly $75 billion in a single session. The largest IPO in history, more than double the previous record set by Saudi Aramco back in 2019. At its peak that week, the company is valued above $2.5 trillion. Bigger than Meta, bigger than Berkshire Hathaway, bigger than Samsung, one of the most valuable companies that has ever existed, on the day it first appeared on a public stock exchange. And the man who founded it becomes, that same day, the first person in history with a net worth over $1 trillion. That figure isn't built on a single stake in a single company. It's the combined value of his shares in this company, and in the electric car maker he also runs, added together and pushed over the line by a single day's stock move. A number that took the entire history of modern capitalism to reach for the very first time, generated inside the span of one trading session. Here's the question almost nobody was asking out loud that week, in between the champagne and the headlines. This same company lost close to $5 billion last year. It lost another $4 billion in the first 3 months of this year alone. Its total accumulated losses since it was founded back in 2002 come to more than $41 billion. And on the same day all of that was true, it had just become one of the most valuable companies in the history of American business. That gap between a company hemorrhaging billions and a valuation that size is what this film is actually about. But to understand how strange that gap really is, you need to understand what this company actually is today. Because the business that rang that bell is not the business most people think they know. If you ask most people what this company sells, they'd say one word: rockets. And that used to be the whole story. It started in 2002. A 31-year-old named Elon Musk had just been pushed out of the company he co-founded, an online payments business called PayPal, right around the time eBay bought it for $1.5 billion. His stake, in today's money, was worth somewhere around $300 million. Most people in that position buy a bigger house. He decided to build rockets. He'd grown up reading science fiction, and he'd become fixated on one idea. Humanity needed to become a multi-planet species, and somehow, in the 30 years since the first moon landing, nobody had seriously tried to go to Mars. So he flew to Moscow to buy a decommissioned Russian missile, got laughed out of the room by a group of engineers who thought he was a rich American with more money than sense, and on the flight home, opened his laptop and started doing the math himself. What he found was that raw materials, aluminum, fuel, wiring, made up only a few percent of what a rocket actually cost. The rest was margin, contractors, decades of bureaucratic overhead. So instead of buying a rocket, he decided to build his own, from scratch, in-house, and founded a company called Space Exploration Technologies, SpaceX, with roughly $100 million of his own money. The first 3 launches of its first rocket, the Falcon 1, all failed. By 2008, the company was nearly out of cash, and Musk was going through a divorce at the same time. He had enough money left for exactly one more attempt. On September 28, 2008, the 4th Falcon 1 reached orbit. It was the first time in history a privately built rocket had done it. 3 months later, NASA signed a $1.6 billion contract with the company. Musk has said he changed his computer login to "I love NASA." 7 years after that, in December 2015, SpaceX did something no government space program had ever managed. It landed an orbital rocket booster back on the ground, intact, ready to fly again. Reusability, the idea that a rocket could work like an airplane instead of a firework you throw away after one use, had been considered close to physically impossible. From there, the pace of the rocket business itself became almost hard to comprehend. The Falcon 9, the workhorse rocket built on that reusability breakthrough, went from a handful of launches a year in the early 2010s to a cadence of roughly one launch every 2 to 3 days by the mid-2020s, using boosters flown, landed, and reflown dozens of times each. Today, the overwhelming majority of everything that goes into orbit, satellites, cargo, astronauts, launches on a rocket built by this company. In most years this decade, this single company has put more mass into orbit than every other country and every other company on Earth combined. That's the story most people already know. Scrappy founder, 3 explosions, then a miracle landing, then dominance. It's a genuinely remarkable engineering story. And it's the story most of the coverage of this IPO has told. It is also, by 2026, no longer the reason this company is worth $2 trillion. Here's what almost nobody outside the filing actually read. Rockets, the thing this company is named for, the thing on the outdoor billboards, are not what pays the bills anymore. There are 3 separate businesses stacked inside this one company, and understanding the difference between them is the key to understanding everything that happens later in this story. The first is the rocket business, launch services for the US government, for NASA, for commercial satellite operators. It's the most visible part. It's genuinely the most advanced rocket program on the planet, and it is not, on its own, what makes this company worth trillions. The second business is the one actually paying for the dream. Satellite internet, a dish about the size of a large pizza box, bolted to a roof in a place regular internet infrastructure never reached. A farm in a rural province, a fishing boat in open ocean, a village in a mountain range, talking directly to a satellite a few hundred miles overhead. No cables, no fiber buried in the ground, just a direct link to space. As of early 2026, there are more than 10,000 of these satellites in orbit, more than every other country and company on Earth combined that have ever launched, added together. A new one goes up roughly every 4 hours. Revenue for this single division came in at around $11.4 billion in 2025 alone, more than 60% of everything the company made that year. And the profit margin on that revenue is somewhere around 63%. To put that number in context, Apple, one of the most profitable technology companies that has ever existed, runs margins in the high 40s. Coca-Cola runs around 33. A satellite internet division quietly is running margins that would make almost any company on Earth jealous. This is the business paying for everything else, the rockets, the research, the Mars ambitions. It's the engine underneath the engine. And then there's the third business, the strange one, the one that barely existed when this story starts. In February 2026, this company absorbed an artificial intelligence startup founded by the same person, an AI company that owns a chatbot called Grok and a social media platform, in a deal reported to be worth somewhere around $125 trillion less than 6 weeks after that merger closed. Musk admitted publicly that the AI company wasn't built right the first time and needed to be rebuilt from the foundations up. And in the months around that admission, every single one of that AI company's original 11 co-founders left. All 11. Gone before the IPO that was partly built to fund their work ever happened. Here's the number that should stop you. This AI division alone lost more than $6 billion in 2025. It burned through another $2.5 billion in the first 3 months of 2026. That's most of the company's total losses for the year, coming from the one division that had just lost its entire founding team. To see how quickly that satellite internet business actually grew, look at the subscriber count alone. It passed 60,000 users in 2022. It passed 1 million later that same year. By 2023, it was past 3 million. By the end of 2025, it had reached 8.9 million. By the end of the first quarter of 2026, right around the time the IPO paperwork was being finalized, it had crossed 10.3 million subscribers in 155 countries. That is one of the fastest subscriber growth curves any telecommunications product has ever posted, and it happened almost entirely outside the traditional cell tower and fiber industry, which is part of why it took the rest of the industry years to fully register what was happening. Now look at the AI division on the other side of the ledger, and the departures aren't an abstraction, they have names. Tony Wu, one of the AI company's original co-founders, announced he was leaving in February 2026. Jimmy Baugh, another co-founder, resigned within 24 hours of that announcement, reportedly amid internal tension over the pace of progress on the company's models. By mid-March, the final two remaining co-founders, Manuel Croix, who had been leading the pre-training team, and Ross Nordine, described by people close to the company as Musk's own right-hand operator on the AI side, were both gone as well. 11 people started that company, 11 people left it, and the timeline of those exits sits almost exactly on top of the timeline of the IPO preparation. So here is the actual shape of the company that rang that bell. A rocket business that is the most advanced on the planet but modest in size next to the other two. A satellite internet business quietly generating tech company margins on one of the fastest subscriber growth curves in telecom history that pays for everything, and a brand new, deeply unproven artificial intelligence division bolted on 6 months before the IPO that was hemorrhaging billions and had just lost every single person who originally built it. 3 businesses, 1 ticker symbol. And that alone should give any analyst pause, because those 3 businesses don't get valued the same way. A rocket launch company with government contracts and long lead times typically trades at a modest multiple of its revenue. The market for it is real, but it's not a market that doubles overnight. A profitable, fast-growing telecom business like Starlink usually commands a much richer multiple, closer to what investors pay for a software company. And a young, unproven, deeply unprofitable AI company gets valued almost entirely on story and potential, since there's little in the way of steady earnings to measure yet. Bundling all 3 into a single stock under a single $1 trillion number means an investor buying 1 share is effectively being asked to accept 1 blended price for 3 businesses that, on their own, the market would price completely differently. And there is no way from the outside to know exactly how much of that one number belongs to which of the 3. And when the company went to Wall Street to explain to investors what it actually was, it didn't lead with the rockets, and it didn't lead with the internet satellites paying the bills. It led, overwhelmingly, with the AI story. We'll come back to exactly what it claimed. But first, you need to understand the part of this story that almost no one covered. How a $75 billion stock offering, floating less than 5% of the company, ended up generating $250 billion in buy orders before the market even opened, because that part had very little to do with rockets, or satellites, or artificial intelligence. It had to do with a rule, if tracing exactly how power and money actually move, not the headline, the mechanism underneath it, is the kind of thing you want more of. Take 1 second and subscribe. It genuinely helps. Now here's the rule that moved first. To understand what actually inflated this IPO, you first need to understand 2 boring but extremely powerful financial concepts. Stay with me. This is the part of the story nobody else is telling, and it's simpler than it sounds. The first is called free float. When a company goes public, not every share it has ever issued gets sold to the public that day. Founders keep shares, early employees keep shares, early investors keep shares. The portion that's actually available for anyone to buy and sell on the open market is called the free float. Most large IPOs float somewhere between 15 and 20% of the company. This company floated 4.2%. Out of roughly 13.1 billion shares outstanding, only about 5 million were ever available to trade. Everything else, the other 95.8%, stayed locked in the hands of the founders, the early employees, and the pre-IPO investors. The second concept is the stock index. Think of something like the Nasdaq 100 as a list, the 100 largest, most important technology companies trading on that exchange. Hundreds of investment funds around the world exist purely to copy that list. They're called index funds, or passive funds, and as of 2026 there are more than 200 separate products, holding roughly $800 billion combined, whose entire job is to hold exactly what's on that list, in exactly the same proportion. Here's the part that matters. When a new company gets added to that list, every single one of those funds is contractually required to buy it. Not because any individual fund manager reviewed the company and liked what they saw, because the rulebook says so. For decades, there was a safeguard built into that rulebook. A new company had to wait somewhere between 3 months and a full year after its IPO before it could even be considered for fast entry into the index. Time for the market to actually test the stock, for the hype to settle, before hundreds of billions of dollars in mechanical, forced buying kicked in. That waiting period wasn't arbitrary. It existed because index funds are supposed to be the boring, safe option. The thing a retirement account holds precisely because it isn't making risky, individual bets on hyped-up new stocks. If a fresh IPO could enter the index immediately, before the market had time to properly price it, every single one of those retirement accounts would be forced to buy in at whatever price the opening week hype happened to set, no matter how inflated that price turned out to be. The old rule was, in effect, a cooling-off period, built to protect exactly the kind of investor who never chose to make an individual bet in the first place. On March 30th, 2026, roughly 2.5 months before this IPO, Nasdaq announced it was changing that rule. New listings could now be fast-tracked into its indices after just 15 trading days, not 3 months to a year. On May 1st, 2026, the new rule formally took effect, and alongside the faster timeline, Nasdaq also quietly removed something else. The old requirement that a company have at least 10% of its shares freely trading before it could even qualify for the index. Companies with a smaller float than that used to be excluded outright. Under the new rule, they're not excluded, they're just weighted differently, at up to 3 times the normal multiplier. Here's what that multiplier actually does. Normally, an index weights a company by its full market value, how much all of its shares, tradable or not, are worth combined. Under the new rule, a company with a thin float like this one gets its trading available portion multiplied by up to 3 before that weighting is calculated, specifically to compensate for how little of the stock is actually out there. In plain terms, a stock so scarce it would once have been judged too illiquid to even qualify, now gets counted as if there were 3 times more of it circulating than there actually is, for the purposes of deciding how much money hundreds of billions of dollars in passive funds are obligated to put into it. And it's worth understanding what Nasdaq itself gets out of any of this. Nasdaq doesn't just operate a stock exchange, it also runs a licensing business, charging index funds and financial institutions fees to use its indices as the benchmark their products are built around. The more valuable, more attention-grabbing companies inside those indices, the more valuable that licensing business becomes. None of that is hidden or improper. It's disclosed in Nasdaq's own public filings as a normal, sizable part of its revenue. It just means the entity that decided how quickly this particular company could enter its most closely watched index was not a neutral referee. It was a business, making a rule about its own product, shortly before the single most attention-grabbing addition in that product's history became available to add. Read those 2 changes back to back. The waiting period got shorter, and the float requirement, the rule that used to keep the thinnest, least liquid new stocks out of the index entirely, got removed. Both changes were announced and finalized in the roughly 10 weeks immediately before the single largest, least liquid new listing in stock market history arrived at the door. Nasdaq is not a government regulator. It's a for-profit, publicly traded company. It earns money from listing fees and from licensing its own indices to the very funds that are required to track them. The same company chose the rules that decided how fast the biggest listing in its history would trigger forced buying from hundreds of billions of dollars. It has a direct financial interest in attracting. To be clear about what this is not, nothing about this was illegal, and no regulator has alleged any wrongdoing. Exchanges are allowed to set their own listing standards. This isn't a story about a crime. It's a story about who gets to write the rules of the game, and what happens when the referee also owns a piece of the field. Here's what it actually did in practice. On June 12th, roughly $250 billion in buy orders chased that $70 billion offering. About 3 times more demand than there was stock available to sell, even before a single index fund was required to step in. Then, on July 7, 2026, almost exactly 15 trading days after the IPO, the precise window the new rule created, the company officially joined the Nasdaq 100, and every fund tracking that index had to start buying immediately, regardless of price, regardless of whether the fundamentals justified it. Think about the mechanics of that for a second. Roughly 555 million shares existed to trade. $250 billion showed up wanting them on day one alone. And 3.5 weeks later, hundreds of billions more in mechanical, rule-mandated buying arrived right on schedule. None of that requires a conspiracy. It requires only that the rules of admission were rewritten by the party that profits from admissions, in the exact window before the biggest admission of all time. Here's why that should matter to you even if you never bought a single share. If you have a retirement account, a workplace 401k, a pension, or almost any general index fund through a bank or broker in the United States, there is a real chance a small slice of your own savings now automatically includes this stock, not because you or your fund manager ever evaluated whether $135 a share or $161 or $2 trillion was the right price. It was added to a list you're passively exposed to, because the list's own rulebook was changed to make sure it would be. That is the actual practical stake in a story that otherwise sounds like it's only about a handful of billionaires and one very large rocket company. Because it isn't. It's about how a rule written in a boardroom you've never heard of can reach directly into an account with your name on it. Not everyone was swept up, and the people who weren't are worth listening to, because their objections weren't about the rockets. They were about the math. Start with the most respected valuation professor in finance. Aswath Damodaran teaches at NYU's Stern School of Business and is often called, only half-jokingly, the Dean of Valuation on Wall Street. Days after the offering, he published his own model of what the company was actually worth. Roughly $1.3 trillion. Not the $175 to $177 trillion the IPO was priced at. Nearly $500 billion less by his own calculation, before the market had even started to correct. He wasn't alone. Morningstar, one of the largest independent investment research firms in the world, published its own valuation work questioning whether the price left any real margin of safety for new buyers. The Financial Times, one of the most respected financial newspapers on earth, ran commentary describing the valuation as difficult to justify against the disclosed numbers. None of these are fringe voices. They're the institutions whose entire business is pricing companies accurately. And in the days around this specific IPO, several of the most credible ones independently arrived at some version of the same conclusion. The price and the numbers didn't match. Damodaran has spent years studying a pattern he calls the big market delusion. Here's how he describes it. Whenever a genuinely enormous new market appears, artificial intelligence, the commercial space industry, dozens of companies rush in at once, and every single one tells a version of the same story about how it's going to dominate that market. Individually, each story sounds plausible. An investor hears it and thinks, sure, that could happen. The problem is what happens when you add all those stories together. They can't all be right because they're all promising a giant slice of a market that isn't actually big enough for everyone's promise to come true at the same time. According to Damodaran, the result is almost always the same. The entire sector gets collectively overvalued. A handful of companies survive and justify the hype. Most don't, and when the correction comes, it doesn't discriminate between the two. He's described the psychology behind it in blunt terms. In his own words, you have to be overconfident to become an entrepreneur in the first place. And you have to be overconfident to become the venture capitalist who funds one. Pour that self-selected overconfidence into a market that is, for once, genuinely enormous. And you get exactly the kind of overreach that produces a correction, once reality catches up to the story. And this company, in its own words, is telling exactly that kind of story. Every company preparing to go public in America has to file something called an S-1 with the Securities and Exchange Commission, a legally binding document where it's required to disclose, honestly, of what it does, of what it earns, and what could go wrong. This one runs close to 300 pages, and buried inside it is a number that should stop you. The company claims its total addressable market, the entire pool of revenue it believes it could someday capture, is $28.5 trillion. For context, That's roughly the size of the entire United States economy in a single year. Of that $28.5 trillion claim, $26.5 trillion, or 93% of it, is attributed not to rockets and not to satellite internet, but to artificial intelligence. The same AI division that had just lost all 11 of its founders and burned $2.5 billion in 3 months. The filing breaks that $26.5 trillion figure down into pieces, and the pieces themselves tell you how far the story has traveled from rockets. $2.4 trillion in AI infrastructure, $760 billion in consumer subscriptions, $600 billion in digital advertising, and the largest single piece, by far, $22.7 trillion, in what the filing simply calls enterprise applications. A company whose public identity is built on reusable rockets is asking investors to price in more money from enterprise software sales than from anything it has ever actually built and flown. And underneath the AI number sits a section of the filing called Future Markets, the part describing what the company hopes to be doing years from now. Space tourism, manufacturing products in orbit, transporting people and cargo to the Moon and Mars, mining asteroids for raw materials, building power stations and factories off-planet, and the most ambitious line item of all, launching data centers into space, satellites carrying AI computer chips, powered by solar panels, processing data hundreds of miles above the Earth, instead of in a warehouse on the ground. The company's own logic is that space has near unlimited free solar power, no clouds, no night, and by its own filing's estimate, panels in orbit generate roughly 5 times more electricity than the same panels do on Earth. While a data center on the ground is constrained by how much power the local electrical grid can actually deliver and how much water it can spare for cooling. It's a real engineering argument made by a company that has beaten skepticism before. It's also, again in the company's own words a few pages later, dependent on technologies that do not yet exist. And here's the detail almost no one reported on the day of the IPO, because it's buried on page after page of dense legal language most people will never read. In a section describing its future plans, things like mining asteroids, building factories on the Moon, and launching data centers into orbit to run AI computing directly off solar power in space, the company's own filing states, in its own words, that these plans involve significant technical complexity and rely on technologies that don't yet exist. Read that again. A publicly traded company in a legally binding document. The exact document a regulator requires to be truthful about risk under penalty of law, telling its own investors in black and white that a meaningful share of the number they're paying for depends on inventions that have not been invented yet, to be fair to the skeptics and the optimists both. This company has a real history of doing things experts called impossible. When the third Falcon 1 exploded in 2008, most of the industry assumed the company was finished. When it landed a rocket back on Earth in 2015, most of the industry called it a stunt that would never scale. It scaled. So dismissing every ambitious claim in this filing purely because it sounds implausible would be its own kind of mistake. Goldman Sachs, the bank that led this IPO, has separately projected the company's revenue could reach $474 billion by 2030, up from roughly $18 billion today. If even half of that happens, this valuation could look conservative in hindsight. Musk himself has set the bar even higher in public comments, saying he'd be disappointed if the company wasn't already generating $100 billion in annual revenue by 2028, 2 years earlier than Goldman's own number. But might be true if the impossible happens again, and the price already assumes it will, are two very different things. And this isn't the first time a story like this has played out. When Facebook went public in 2012, its opening day valuation priced in years of mobile advertising growth that hadn't happened yet. The stock fell to roughly half its IPO price within 3 months. It eventually more than made up for it. $1 invested at the low is now worth many times over. When Uber went public in 2019, the stock dipped, then climbed steadily as the underlying business matured. When Rivian, the electric truck maker, went public in 2021 at a valuation implying it would out-execute nearly the entire auto industry, the stock lost more than 80% of its value within a year. And as of today, still hasn't come close to recovering. Same pattern. Three different outcomes. And it isn't only an IPO day phenomenon. Sometimes a company can be a genuine, world-changing business, trade at a genuinely inflated price for years, and simply never fully reward the people who bought in at the top. Petrobras, Brazil's national oil company, was briefly the most valuable company in the world in 2008. Investors who bought at that peak waited more than a decade just to get their money back, and even then lost ground to inflation the whole way. Cisco was the most valuable company on Earth in the year 2000, at the height of the dot-com boom, building the literal hardware the internet ran on. A real, essential, dominant business. Investors who bought Cisco stock at that peak, still, a quarter of a century later, have not recovered their initial investment. Microsoft in 1999 was the most admired company in American business. Investors who bought at that specific peak waited 17 years just to break even. In every one of those cases, the underlying company went on to remain important, sometimes hugely profitable, sometimes central to the entire economy, and the stock still failed the people who bought it at the wrong price. None of those three companies vanished. None of them turned out to be frauds. They simply cost too much on the day people fell in love with them, and the market took years, sometimes decades, to admit it. A great company and an expensive stock can both be true about the same business at the same time. And history suggests that gap can take a very long time to close, if it closes at all. The only honest answer at the moment of the IPO itself is that nobody, not Damodaran, not Goldman Sachs, not this documentary, actually knows which of those outcomes this company becomes. What we can say, with certainty, is what has already happened since. So, what actually happened in the 5 weeks between that opening bell and today? For the first few weeks, the story looked like pure triumph. The stock kept climbing past its opening price, briefly touching a valuation north of $2.6 trillion, making the company, for a moment, the sixth most valuable publicly traded business in the United States, ahead of household names most people have used products from for decades. Then, on July 7th, exactly on schedule, the company officially joined the Nasdaq 100, and the forced mechanical buying from more than 200 index tracking funds began, right when the rule change guaranteed it would. Analysts estimated the near-term mechanical buying, just from the largest trackers, the ones built directly around the Nasdaq 100 and the broader Russell indices, at somewhere between $22 and $27 billion in the days immediately around inclusion. And that's only the fast-moving portion. Once every fund with any exposure to these indices eventually rebalances, the total forced buying tied to this one listing could ultimately exceed $100 billion, money that has nothing to do with any fund manager's individual judgment about whether $135 or $161 or $2 trillion, but was ever the right price. You'd expect that kind of guaranteed demand to keep pushing the price up. Instead, something else started happening at almost the same time. Short sellers, investors who make money betting a stock's price will fall, began building up bets against the company right as the mechanical buying was supposed to be at its strongest. One financial commentator went as far as to describe the deal, in print, as potentially Wall Street's worst capital misallocation ever, a phrase normally reserved for the most infamous bubbles in market history. That's one opinion among many, not a settled verdict. And this documentary isn't going to pretend it's a consensus, but the fact that language that strong was being used about the biggest IPO in history within weeks of the celebration at the Nasdaq building tells you how quickly the tone around this stock had already shifted. To be clear about what short sellers building up bets actually means in practice, it means professional investors are borrowing shares, selling them at today's price, and betting they'll be able to buy them back later at a lower price to return what they borrowed, profiting from the gap if the stock falls. It's a bet that only pays off if the price genuinely drops, which means the people making it are putting real money behind the belief that the current price won't hold. A wave of that kind of positioning building up this early, on a stock this large, this soon after its debut, is itself a signal, not proof of anything, but a sign that a meaningful slice of sophisticated money was betting against the momentum almost as soon as it started. Lay the full price arc out in order, and the pattern is hard to miss. June 12th, Priced at $135, opens at $150, trades as high as $176.52 by the end of day one, closes at $161.11. In the days that follow, climbs further, briefly touching a share price above $225 and a valuation near $2.6 trillion at its absolute peak. Then gradually gives almost all of it back. And on July 16, 2026, just yesterday, as this is written, the stock fell back below its $135 IPO price for the first time since the offering. 5 weeks. That's how long it took for the biggest IPO in history to trade for less than what it cost on day one. Every investor who bought anywhere near that $225 peak, believing the momentum would continue, is now sitting on a loss of more than 30%. And that's before a single one of the scheduled lockup tranches has even started releasing new supply. Here's why the timing matters. Almost none of the people who actually hold this company's stock have been allowed to sell a single share yet. The lockup period, the standard rule that keeps founders, employees, and early investors from cashing out immediately, is still mostly in effect. But it isn't a single date. It's staggered, in tranches. Around 20% of insider-held shares are scheduled to unlock in late July or early August, timed to the company's next earnings report. Then roughly 7% more every 2 to 4 weeks through October. Then another wave, close to 28%, tied to the third quarter earnings release. The rest unlocks on the standard 180-day mark, December 8, 2026. Analysts tracking this have put a number on just the first major unlock. Roughly $123 billion worth of shares becoming eligible to sell in early August alone. More than 60 times the size of a typical large-cap lockup release. Remember, the entire free float on IPO day was only about $75 billion worth of stock. A single unlock wave, a few weeks later, is larger than the entire original public offering. And it isn't only Musk sitting on the other side of that unlock. Reporting around the IPO put the number of SpaceX employees who became paper millionaires that day at roughly 4,400, engineers, technicians, and staff across the company, many of whom took equity compensation over cash for years, betting on exactly this outcome. Their shares are on the same staggered calendar as everyone else's. That's not a criticism of any individual choosing to eventually sell stock they earned. It's simply the supply that is about to meet a stock already trending toward its IPO floor, tranche by scheduled tranche, for the rest of the year. This is the moment the veteran investor George Noble was pointing to when he published a widely shared thread in the days after the IPO. He didn't call it fraud, and he didn't allege anyone broke a rule. What he called it, his words, not a legal finding, was the largest exit liquidity operation in history. His argument, a structure this thin on float, added to an index this fast, with this much of the company still locked up, was never primarily about giving the public a fair shot at ownership. It was about giving early insiders, who bought in years ago at a tiny fraction of today's price, a liquid, high-priced market to eventually sell into. Once the lockups start lifting, nobody forced retail investors to buy on day one. But it's worth noting, this company reserved close to 30% of the offering for individual investors, roughly 3 times the typical 5 to 10% allocation on a deal this size. More ordinary people were pulled directly into this specific structure than into almost any comparable IPO in recent memory. Ask yourself why a company might choose to do that. A larger retail allocation means a broader, more emotionally invested base of small shareholders. People buying because they trust the brand and the founder, not because they ran a valuation model, which historically tends to be stickier, slower to sell in a downturn, and more resistant to short-term price swings than institutional money. That's not evidence of any intent to deceive anyone. It might simply be smart, standard investor relations strategy. But it does mean that when the professional, sophisticated side of the market started quietly positioning against the stock through short bets, the retail side of the shareholder base was, by design, the slower-moving, less hedged group left holding the other side of that trade. So where does that leave the story? Not with a verdict on whether this company is a good investment. That isn't a question this documentary is built to answer, and anyone who tells you they know for certain is selling you something. The rocket business is real, and it's genuinely the best in the world at what it does. The satellite internet business is real, and it's already one of the most profitable telecommunications businesses on the planet. The AI business is real too. It's just also the newest, the least proven, the most expensive, and the one carrying almost the entire weight of a $26.5 trillion promise, made by a division that lost its entire founding team before the promise was even priced into a stock. What we can say with more confidence is this: the size and the speed of that first-day valuation, the number that flashed across every screen and every headline on June 12th, were not purely a referendum on any of those three businesses. They were substantially the product of a rule change made by the exchange itself in the 10 weeks before the listing that guaranteed mechanical, forced buying regardless of price. And now that the free float is starting to widen, as scheduled, as disclosed, exactly as the lockup calendar always said it would, the price is finding out in real time what the stock is worth, without that artificial scarcity holding it up. That's the pattern worth remembering, and it's bigger than any one company. The next time a company this large, this hyped, wants to go public, and there will be a next time, the rulebook it walks through the door with will have already been rewritten in its favor by an exchange with a direct financial stake in seeing it succeed. That's not a scandal with a villain and a headline arrest. It's quieter than that, and in some ways it matters more, because nobody has to break a single law for it to keep happening again. Think back to who actually wrote the two rule changes that made all of this possible. Not a court, not a regulator answerable to voters, not even the shareholders of the funds who were about to be required to buy in. A private, for-profit exchange, deciding for itself how carefully or how quickly the newest, largest, and least liquid stock in market history would be allowed to reach the accounts of ordinary retirement savers. The rocket company at the center of this story didn't write that rule. It didn't have to. It only had to exist at exactly the size and the moment that made rewriting it worthwhile for someone else. That is the quiet mechanism underneath almost every story this channel investigates. Not a single villain making a single illegal choice. A system built by people with an obvious and undisclosed nowhere interest in the outcome that produces the exact result you'd expect, legally, procedurally, and almost invisibly, unless someone stops to trace how it actually works. And remember who was standing closest to that mechanism when it activated. Not just the billionaire founder. He was always going to be fine, whichever way the stock moved this year. It was the roughly 30% of this offering that went to individual investors, ordinary people trusting a familiar name during the exact window. A newly changed rule was pulling in the largest wave of guaranteed price-agnostic buying an index has ever produced for a single stock. Some of those investors bought at $135 and are, for now, still ahead. Some bought during the run to $225 on the assumption that the momentum itself was the signal. The rule change didn't care which one of those buyers it was working for. It doesn't take a side, it just moves the money, mechanically, on schedule, whether or not the price it's paying happens to be the right one. So, after everything you've just seen, who actually decided this company was worth $2 trillion on its first day of trading? Not purely the market, not purely the crowd outside the Nasdaq building that day, cheering, or the retail investors who bought in believing the biggest names in the world. Simply don't get it wrong. Part of that number was decided months earlier, quietly, in a rule change most of the people who bought the stock never read, written by the one institution in this entire story, with a direct financial interest in the outcome. The rockets are real, and they are genuinely the best in the world at what they do. The satellites are real and profitable, quietly paying every bill underneath the headlines. The AI bet might someday be real too. This company has beaten longer odds before, more than once. But the price you saw flash across the screen on June 12th, the number that made one man a trillionaire before lunch, was never only a measurement of any of that. Some of it was simply the rule that moved first. If you want to understand the other half of this story, the AI compute race this same company is now betting $26.5 trillion of its valuation on, and the power grid straining to keep up with all of it. That's coming next, right here on this channel. I'll see you there.